Hello everyone. Good evening to all. Welcome you all in this session. So today we are starting our marathon session 2, that is module B. So in the morning we completed our module B, and in this session we will be doing some MCQs related to module B. So in this MCQs you will be having some numerical problem also, case studies also, true false question also, match the following, and some direct MCQs. Clear? So these all types of questions we will be covering in our this particular session. So I hope I'm audible. My slide is clear to you. Everything is fine. Just confirm me. Yes. Should I start the session? Yes. Good evening, Swati ji. Okay. Chalo. So let's start the session. Now, this is our capsule batch. So in this capsule batch, this is your last minute revision batch where we are covering all important and relevant concept. Okay. All the concept which are related to your exams from where the multiple questions have been come. So we are discussing in this capsule batch. So all your one step preparation towards your exam. Clear? Now, in English medium batch, Pradyuman sir is taking the classes, and if you are comfortable in watching the session in English medium, then you can join my batch. So we have done 4 lectures so far, and in all these lectures from 7 a.m. to 9 a.m. in the morning. Now, so first question is that again in this session we are having approx 70 to 73 questions. Chal. So first question is in front of you. You have to answer the question before mentioning your answers. Do mention the question number before that. Now, which statement is incorrect about term loans? Term loan is major source of short-term finance or long-term finance? Tell me. It is a major source of long-term finance. Now, this source is different from equity, relatively cheaper to service. Short-term loans are repaid within a year, less than 1 year. Medium term has 1 to 5, and long term is for a period of 5 to 10. Now, in this question, it was asking that which is the incorrect statement. So, this is a major source of long-term finance. Option number A. Clear? Now, next question related to preference shares. Come on, give me your answers. Incorrect. You have to find the incorrect statement. This is that part of capital which provides less risk to investor compared to which is taken by the equity investors. Yes, why equity investors are risky? Equity is a preferred stock, preference shares is a common stock. Is it so? Common stock, we have seen the other name of common stocks. What are the other name of common stocks? The common shares, then common stock, owner's capital, and equity capital. So these all names are the different names of equity capital. So this statement is incorrect. Now, holder gets preference with respect to dividend. Yes, when company gets liquidated, they also get the preference of dividend. In a quasi-risk capital, because it is not safe as secured debt, which get payment priority over preference shares in case of liquidation of a company. Now, so these preference shares, when the company makes the profit PAT, the first is what the company pays all the debt. After that, whatever is left, the company will first give to its preference shareholders, and then whatever is left, the company will give to its equity shareholders. Clear? Yes. Now, next, question number 3, 4 statements are given to you. You have to find with reference to redeemable and irredeemable preference shares. Which statements are correct? Redeemable and irredeemable are what? Redeemable means the repayment date is fixed. Repayment period is fixed. When company can buy back its shares, that is redeemable. Now, irredeemable when the payment period is not fixed. So, redeemable preference shares can be bought back by the company at a preferred future date at a prescribed time. Yes. Irredeemable preference shares cannot be bought back only at case of when the company gets wind up or liquidated. Then only these shares are given back to the company. Yes, this is also correct. Now, redeemable preference shares, they provide flexibility in capital management. Yes, this is also correct. How? See, when redeemable preference shares is being given to you, it means when company feels that the loan rate, the interest rate is going high or down, so accordingly that they will buy back the shares or they will issue their shares. So that is, it provides flexibility depending upon the interest rate. Now, irredeemable preference shares, also known as perpetual. Perpetual means their existence is there. So that this is also correct. Irredeemable means when the repayment date is not fixed. All the statements are correct. Clear? Now, next question number 4. Which source of finance allows business to sell their accounts receivable, the bills receivable at discount? Like the accounts receivable is for rupees, let's take in 100. Now, this business is selling to a third party at rupees 80. Now, what type of function is called? Trade credit, factoring, equity financing, or grants. And those who are new to this channel, kindly subscribe the channel because right now we are having our ABFM paper, then you are having your BRBL paper, then you are having your elective paper. So all the videos will be in English medium. It will be uploaded in this channel. Yes, that is known as factoring. Factoring is called a factor business. A third party business is there. When you want urgent cash, then you can encash through this business at a discounting price. Why? Why discounting? Because see, if this business is giving you the funds before your actual date, so they will also see na, that there should also be the profit of my business. So that is why they will give you at discounted rate. Like 100 is the value, they will give you at 95. Okay, the document contains of rupees 100, the accounts receivable, they will give you 95 on behalf of this document. And when the repayment date comes, they will collect that payment to the seller, to the buyer. Now, question number 5. Question on basis of decision tree. Decision tree analysis. See, what the question says, a company faces a decision to launch a new product or not. Now, decision tree, what it tells you? It tells you with the help of chart, the diagrammatical representation that is this decision good for your company or not? Like you want to launch a product. If you will make the decision tree, you can easily analyze that launching a product will give you profitable business or not. Now, if launched this product, there is 60% chance of high demand. High demand means the profit is let's take this 4 lakh rupees. And there are 40% chance of low demand. Suppose this is the product you have to launch. Now, if there is demand is high, then 60% is the profit, that is 4 lakh. If demand is low, then there are chance of 40%, only 1 lakh you will earn. And if you will not going to launch, again profit is 0. So again there are 60-40 chances to 2:3 ratio is there. Now, company also conduct market research for rupees 20,000, which will perfectly predict their demand. So you have to find what is the expected monetary value if the company launches the product. Now, what is the chance of 60%? Profit is what? That is 4 lakh rupees. And there are chances of 60%. It means 2,40,000 is the chance of profit. Again, if low demand is there, still there are chances that you can make the profit of 40% from 1 lakh. So again, 40,000. Now, and if you will not going to launch, again profit is zero. The company also conduct market research, which will perfectly predict demand. But the question says what? It says that company launches the product without market research. So if it is without market research, no monetary value of market you will going to add over here. Why? Because the question says without market research. So total value is 2,80,000. Yes, this is option number. If the question says that with included market research, then you will add 20,000 here. So it will become 3 lakh. Clear? Done this question? Now, so this is the explanation. Next. Next is CAPM model. Full form of CAPM model is what? Capital Asset Pricing Model. In CAPM model, what does RF represent? RF is what? That is RF represents your risk-free rate. Now, what are the risk-free rate? Return on equity shares, high risk. See, it is high risk, then you will exclude this. Return on company bond, again, if company goes on loss, then you will make more loss. There is more risk in company bond. Now, risk-free rate is what? Your returns on government bonds. Option number D. Yes. Now, what does beta represent? Beta is this. Beta is what? That is systematic risk relative to the market. Now, what is the CAPM model? So, formula is RM plus beta, RM minus R. Now, next question, you have to find degree of financial leverage. So, what is financial leverage? EBIT upon EBT. So, what is the chart? Income statement, sales minus variable cost, contribution, minus fixed cost, EBIT, minus interest, tax, sorry, EBT, then minus tax, you will get PAT, or you can say PAT, that is profit after tax. And if you will divide this part from number of shares, you will get the value of 1 share. Number of shareholders, you will get the value of 1 share. Clear? Now, sales are what? Sales are 24 lakh minus variable cost. 50% of 24 lakh, again 12 lakh is the variable cost. What is the contribution? Contribution is 12 lakh. Now, in this 12 lakh, deduct fixed cost 10 lakh. 2 lakh is what? 2 lakh is your EBIT. Less interest. Interest is what? 10 lakh at 10%. So 10% of 10 lakh is what? 1 lakh. minus tax 50,000 comes 50,000. Now we only get we only have to know till EBIT. Now EBIT is what 2 lakh, EBIT is what 1 lakh. So that is 2 times. Option number D. Clear? Now next, which statistical measure is central to Hillier model for comparing projects? Again, one type of model for analyzing your risk in your project, Hillier model. Mean, standard deviation, variance, or skewness. That is option number B, standard deviation. See, what is Hillier model? Hillier model is another method used by investors to analyze your risk involved in your decisions which you are taking related to your investment. And likewise, all other model, this model is also based on your NPV, net present value. Now, the name of the professor is important who created this. Now, what Hillier believed that risk in cash flows can be measured using standard deviation. So risk will be measured with the help of standard deviation. Like suppose, let's take an example. Year one, you are receiving in first year you are receiving 10,000. In second year you are receiving 40,000. In third year you are receiving 95,000. In fourth year you are receiving 20,000. In fifth year you are receiving 60,000. If you will see that the cash flows, okay, suppose you have invested, let's take an example, you have invested 3 lakh rupees. Now, if you will see the cash flows that in first year you are getting 10,000, then 40, then 95,000, 20,000, you will see that cash flows are not even. Means there are very much, you can say, deviation between the cash flows. Okay, differences between the cash flows. So standard deviation, what it tells you that it shows how much cash inflows vary from their average point, from their average midpoint, how much cash, like if you have taken this average point, now from this, how much is the cash flows deviating? 10,000, 95,000, 20,000, 95,000. So if your deviation is low, then you are having low risk. If cash flows inflows does not change much, there is less risk. But if there is high deviation, if cash flows and inflows fluctuate a lot, means first year you're getting 10, 40. If you're getting first year 10,000, second year 12,000, third year 14,000, fifth year 20,000, sixth year 18,000. So you will see that your cash flows are not that much fluctuating. But here your cash flows are very much fluctuating. So again, risk is high in this and risk is low in this. Now, this risk only measures what? The Hillier model. Clear? That is why standard deviation is the answer. Now, column A, column B. Now, Voltaire model, what it says that their internal financing is relevant to the company. Now, Gordon model, what it says that there should be the Gordon model has given what? The growth formula, the dividend growth formula, that is constant growth. Now, theory, is Modi-Gilani and Miller approach. Now, this theory says that the dividend is irrelevant. Theory, what it says that you are distributing, if you are distributing dividend to your shareholders, it will create nothing in your company. It will neither increase your company nor it will decrease your company. The value of the firm will still remain same. On the other hand, Gordon what says that distribution of dividend is important for the company. If you will distribute dividend to your shareholders, they will be happy and they will work more for that company. So relevance is given, constant dividend, more growth is given. Now, residual theory, that is dividend distributed after profitable projects. So that is 1, 4, 3, 2. Clear? Now, next. If a stock has a beta greater than 1, it means what? If beta is greater than 1, if it is beta greater than 1, it is more risky. It means your stock is more risky, so it is more volatile than the market. Now, identify the ratios shown below which are used for calculating financial leverage. So we have debt to equity ratio, debt upon equity, interest coverage ratio, dew point analysis. Dew point analysis is your ROI, return on investment, and debt to EBITDA. EBITDA, earnings before interest, depreciation, tax, amortization. It should be EBITDA. Okay. Now, but debt to liability ratio, is it any type of ratio? Is it any type of ratio? No. 1, 3, 4, 5. Option number D. Done. So the dew point analysis is what method used to understand why companies with ROE is high or low. Okay. So that is your return on equity is high or low. ROE is in 3 parts, and this is the formula. Next question 30. You have callable preference shares, adjustable rate preference shares. 4 statements are given. Which one is the correct? Now, callable preference shares are what can be bought back by the company at a preset. Callable means when company will call for their shares. Now, callable preference shares, they can be bought back by the company. Yes, true. Adjustable rate preference shares means the rate of preference shares is adjusted on market condition. That condition may be your interest rate. That condition may be your guidelines. That is adjustable. Have dividend rates that change with market interest rate? Yes, this is also correct. Callable preference shares gives more control to the company. Yes, the callable is just the another name of redeemable. Yes, it gives more control means it is flexible. Just now we have studied. Adjustable share protects investor from interest rate fluctuation. That is why it is known as adjustable. It adjusts its rate from the market condition. All the statements are correct. Now, question number 40 and question number 50. Which of the following best describes the transaction exposure in foreign investment? And this one. If you will apply your analytical thinking, you can easily solve this question, even if you don't know the answer. What is transactional exposure? From the word transaction means what? It simply means give and take. Now, what you will give and what you will take, relate every statement. Risk that foreign subsidiaries financial statement must be restated in the present company's currency. It is talking about the currency. Risk that future cash flows will change due to the unexpected market condition. It cannot be sold quickly at reasonable price. The risk that exchange rate fluctuation will change the value of contract before it is settled. So this is transaction exposure. Now, question number 15, the risk that arises when a company's foreign currency denominated assets and liabilities are converted into their home country. When foreign countries currency is converted into the home country currency, then what that phenomena is called? That is called the translation exposure. Clear these two? Now, what is translation risk? The exposure, translation risk, also known as accounting exposure. So it happens when a company has assets or liabilities in a foreign currency, but it has its main office, or you can say it does its business in its home country. Like the, if you like, suppose let's take an example. You have your parent company in USA and you have your subsidiary in your home country, that is India. Now, whatever business you are making in USA, the currency of USA and the currency of India, is it same? Is it same? 1 rupee is equal to $1? No. That is what. So when the value of foreign currency changes, the value of those assets and liabilities will also change when you bring them in your home country. Clear? This is called translation exposure. Now, next. Which of the following is true regarding relationship between risk return in foreign investment? Risk and return. There is theory, na? If you will take more risk, you will get more return. So relate this question from that theory. Correct. Higher risk is generally associated with higher expected returns. Now, what type of risk can be reduced through diversification? Diversification means what? That is you are distributing your part of your business or your activities to different areas. That is diversification. So that you can minimize your risk. For risk minimization, the best activity is what? That is diversification. So what type of risk can be reduced from this? Systematic currency economy. So that is unsystematic risk. Now, what is systematic and unsystematic risk? I have written over here. Systematic risk is market risk. Systematic means when whole country gets affected by this. This is the risk that affects the entire market or economy. It cannot be avoided. It is just like your pestle. You cannot avoid this now. These are uncontrollable. You cannot control these. These are not in your hand. Now, inflation, recession, can you control all these things? No, you cannot control. Like COVID-19. Okay, with COVID-19, the entire stock market was disrupted. Can you control this? No. So, systematic risk is a risk which you cannot control. It cannot be reduced by diversification. Whereas unsystematic risk is what? This is industry specific risk. This is the risk which you can control. Like poor management, you can control that. Labor strikes, you can control that. Product failure, you can launch new product or you can do the modification in that product. Bad marketing decisions can be converted into good marketing decisions. So this is what? This is unsystematic, which you can control and it can be reduced by diversification. Clear? Now, next is what? Again, this is PYQs. Why? Because it is red mark. Right, read the right side of the part because it is a bigger one. Now, this represents the maximum amount of capital that companies authorize. Now, maximum amount of capital that company can authorize, that is known as registered capital. Now, another name of registered capital is what? Another name of registered capital is a authorized capital. It is the portion of the issued capital that is subscribed by the public, applied for, and again allotted by the company for the same. Now, which is this? Which type of capital is this? Subscribed by the public means public has paid for this. Now, this capital is the amount of money company can receive from shareholders in exchange of shares. Wait, this paid up capital is 3-1. Wait, paid up capital is 3-1. Now, forfeited shares forfeited by the company when it is not fully paid up. So company will forfeit the share, company will take back the share, that is forfeited shares. Authorized capital is the registered capital and subscribed capital is the portion of issued capital that is subscribed to by the firm. So it is 3, 4, 1, then 2. 3, 4, 1, 2. Option number A. Yes, correct. Option A. Yes. Now, 90. Kumar and Sons has rupees 10 equity shares amounting to 15 crore. Current market price equity share is rupees 60. Now, prevailing risk-free interest rate is what? On 10 years, JOI bond is 5.5. Now, risk-free interest rate, Government of India, that is RF is given how much? 5.5%. Average market risk premium is what? 8%. Market risk premium is RM minus RF is 8%. Now, and the beta of the company is what? Beta means the risk 1.1875. Now you have to find what? That is cost of equity. Okay, K. Now, how you will find what is the formula? K is equal to RF plus beta RM minus R. Now, what is RF? Risk-free rate 5.5% plus beta is 1.1875 minus RM minus RF is given 8%. So 5.5% plus this is what? 0.1875. That is 9.5%. Now 9.5 plus 5.5, that is 15%. So answer is option A. Understood? Yes, it is option A. Now next, what is net present value? An investment should be accepted if and only if NPV is exactly equal to 0. If your NPV is exactly equal to 0, it means what? You are indifferent. An investment should be rejected if NPV is positive. If your NPV is greater than 0, it is what? It is positive. You will reject it. No, it is wrong state. Investment should be accepted if NPV is positive. and rejected if it is negative? Yes, this is the correct answer. Yes, correct. 20, correct. See, now you have to find the combined leverage. Combined leverage is fixed leverage into operating leverage. What is the formula of combined? Contribution upon EBIT. How to find contribution? Sales is 1 lakh minus variable cost 40,000. Fixed cost less 30,000. Interest, that is 20,000. Minus variable cost, this is contribution, minus fixed cost, EBIT. Contribution 60 upon 30, that is 2 times. See, if you will see the pattern of December, okay, if you will see December 2024 pattern, only 10 to 12 marks of numericals were asked in the question. But before that, the numericals were asked almost 20 to 30 marks from your 100 marks. So take the weightage of 20 to 30 marks of the numerical questions. But again, IIBF can follow any pattern. Last year, they asked only 10 to 11 marks of numericals. It is even more. Even only 8 to 10 numerical, 8 to 10 marks of numericals was asked. Okay. Now, next, so this is the formula of OL, FL, and CL. 3. Now, this is the case study. Read it. I'm giving you 2 minutes to read this. Done. Now, what the case study says, Unity Bank is a mid-sized commercial bank operating in a competitive financial market. Now, total assets were 20,000 crore, funded by 1,000 crore in equity and 90,000 crore in debt and deposits. So, leverage ratio was 20:1. It means for every 1 equity, you have 20 assets. Now, bank use high leverage to maximize returns on equity. So, if you will take high debt, you will make more returns. But again, with this return, there is risk also. Regulatory authority implemented stricter Basel III norms to require the minimum leverage ratio. So why Basel norm 3? So that you can use less, your leverage ratio should be less, minimum. If you will, the leverage ratio is high, it means you are taking more debt, and more debt means more risk. So that is why they have kept the leverage ratio minimum. And high capital buffer. Capital buffer means the extra amount in your emergency time. Now, if we talk about Unity Bank's management, high leverage can boost the profit in good times, but also increases risk. If the value of loan declines, so again, equity base will not be enough to absorb all the losses. Why? First, they have taken the debt, and if they have taken the debt and they have bear what loss. So again, more and more loss is there in this company, threatening solvency. So board debate that whether to raise your equity, reduce your lending, or maintain the current structure balance, that is balance between the debt and equity. Now, based on this passage, we have few questions. Now, Unity Bank's leverage ratio of 20:1, what indicates? Low level of risk exposure is there. The bank assets are mostly financed by equity. Assets are 20 times in equity, reflecting high financial leverage or equal to its equity. That is, the bank's asset are 20 times its equity. Now, Basel Norms 3, why Unity Bank maintain a minimum leverage ratio? What was the reason? So that you can borrow less and bank can ensure that there should be less losses. You can absorb more and more losses. If Unity Bank chooses to reduce lending to improve its leverage ratio, what is the result? If you will decrease your leverage ratio, what will be the result? There will be, if leverage is less, it means you have taken less debt from the bank. If debt is less, then how you will do the investment? If you will not do the investment, then there is less returns on your equity. So decrease in total assets, potentially lowering returns on equity. Now, 25. Which strategic action can Unity Bank take to comply with Basel III norms? They can raise more equity capital to strengthen its capital base. Now, question number 26 on ABC costing. Activity-based costing is what? That if you make any kind of product in your business, definitely that product will go through certain stages. And the cost of every stage is different. Now, when you will calculate all the cost of different stages, that is called activity-based cost. So ABC allocates overhead cost also based on its activities that drive cost, the cost driver. Yes, it is more accurate than traditional costing in assigning cost to product. It ignores non-manufacturing costs. Is it so? ABC ignores non-manufacturing costs? No, it does not ignore. And it helps in identifying cost driver. So all the statements are correct except the third one. So first, second, and fourth are correct. Option number B. Now, next question. Again, four statements are given to you. ABC assigned cost to activities based on their resources. Yes. ABC is used for manufacturing and for all types of service organization. Yes. It is less complex than traditional costing or it is more complex. You are using modern methods. So again, complexity is more. No? So statement 1, 2 and 4 are correct. Option number C. Now, 28 and 29. Combined leverage is given 2 and financial leverage is given 1.25. Now, combined leverage is what? 2. Financial leverage is 1.25. Combined leverage, we know that it is OL into FA. Combined leverage is 2 OL into 1.25. So let's take OL as X. So 2 is equal to 1.25x. Now x is what? 2 upon 1.25. That is, calculate, wait, let me calculate 2 divided by 1.25. It is 1.6. X comes 1.6. Now x means what? That is operating leverage. So option number C. Yes, correct, Swati ji, C. Now, if your operating leverage is 4, this means a 10% change in sales will cause operating leverage. Degree of operating leverage is what? That is percentage change in EBIT upon percentage change in sales. If you will do 10% change in sales and your operating leverage is 4, it means 10 into 4, 40. So there will be 40% change into EBIT. Clear? So this is the answer of previous question. Now, again, previous year question. Which statement is incorrect about debentures? Section 71 Companies Act contain provisions relating to issue of debentures. True. If debentures are issued to more than 100%, trustees are required. It is wrong. If debentures are issued to more than 500%, then trustees are required to appoint to look after their interest. These are paid on fixed date. Debenture holders get what? Likewise, they get interest. Company is issuing debentures, put option and call option. Two options are given to you. Okay. Company can also ask for their shares, and the investors, they can also claim for their shares. That is put and call option. So option B is incorrect. So 500%. Now, degree of financial leverage. So what is degree of financial leverage? That is percentage change in EPS upon percentage change in EBIT. If you will do the changes in your EBIT, what will be the change in your EPS? So when DFL is more than one, financial leverage becomes relevant. A positive DFL means firm is operating at a higher level than the break-even point. Break-even point is a point where there is no profit, no loss. Financial leverage means what? Tell me, what is financial leverage? See, operating leverage is what? Your fixed cost. It describes your business risk. Financial leverage is your interest cost. It describes your financial risk of the company. And total leverage is your what? Combined cost, fixed and interest, F plus I. It will describe your total risk in your company. So a positive DFL means firm is operating at a high level than the break-even point. Yes, true. This is also true. EBIT means sales minus variable cost plus fixed cost excluding interest. This is also true. Now, when DFL is less than 1, the financial leverage becomes relevant. Now, if you will see that A and D, these two statements are contradicting each other. So either this one will be true or this one will be true. And in the question, it says the incorrect statement. So when your DFL is more than 1, see, if you will see the, wait, suppose, let's take an example in the year 2020, in the year 2021, and the percentage change. Now, suppose in the year 2020, your EBIT, let's take 20 lakh. In 2021, it is 22 lakh. Now, tell me what is the percentage change? How you will find the percentage change? 22 minus 20 lakh, 2 lakh upon 20 into 100. That is what? 10%. Percentage change is 10%. Now, it talks the relationship, financial leverage talks the relationship of EBIT and EPS. Now, if your EPS, let's take rupees 100 in the year 2020, if it increases to rupees 120, what is the percentage change? 20% is the change. It means that rupees 1 change in EBIT will bring twice change in your EPS. Means if rupees 1 is EBIT, then rupees 2 will be your EPS. So if it is more than 1, it becomes relevant. So that is option D will be your incorrect. Clear? So this is all the explanation for that. You can read it later on by downloading the PDF. Now, which of the following statement best differentiates between sensitivity analysis, scenario analysis, simulation analysis, and decision tree analysis? So sensitivity analysis talks about that if you will do keeping all other factors, if you will do the changes in one variable, what will be the effect in the profitability of the project? That is talked by sensitivity analysis. Now, one variable at time it changes. So you can learn in this way. If you are confused in learning, see, you see that I is there, so you can learn in this way that only one variable is changed at one time. Now, in scenario analysis, we talk about 3 scenarios. Alphabetical order, if you will see A, B, C. C is at the 3rd place. So in this, we talk about 3 scenarios. The best one, best is also known as optimistic. Then second is worst one. Worst is known as pessimistic. And the normal one. Simulation analysis, it uses probability distribution, very important. And in the simulation analysis, we test multiple variables. We train multiple models with the help of AI tool. And decision tree analysis will help you to identify that which decision is good for you. That is option A. Now, next is you have to find ARR, average rate of return, or accounting rate of return. ARR follows which type of cash flow? It follows profit after tax. Suppose in the question CFAT is given to you, cash flow after tax, then how you will find the PAT? You will less depreciation from CFAT, then you will get your PAT. And if in the question like NPV is asked and which profit is given to you, which cash flow is given to you, PAT. So what you will do simply in this, you will add depreciation. to find your CFAT. So these are all the basics of your capital budgeting technique. Now, what is the answer? Now, full form of ARR is what? Average PAT upon average investment. Now, average means what? That is opening plus closing divided by 2. If in the question residual value is given, if in the question scrap value is given, if in the question end value is given, so all these are what? These are your closing balance. So company management is considering crore, 1 crore investment in a project life of 5 years. No residual value is given. It means no closing balance is given. Now, total income from the project is expected 60,000. 60,000, but life is given 5 years. Now, here we have to find the, what average. So, 60 lakh upon 5, 12 lakh. Wait, let me erase all this. Have you noted this term? Understood? Should I erase it? Clear? Now, average PAT upon average investment. This is the formula of ARR. Now, 60 lakh divided by 5. This is what your average profit, 12 lakh. Now, you have got your average PAT. Now, average investment is what? Only opening balance is given to you 1 crore. No closing balance is given to you. So that is what? That is your 50 lakh. Now, we know that we have to find the answer in profit. So average PAT is 12 lakh upon 50 lakh into 100. 30, 5, 2 are 20. That is 24. So 24% is the answer. Correct? Now understood? How 24%? Clear to you, ma'am? It is answer is 24%. Now, again, ABC, you have to find the limitations. Limitations means the drawbacks. ABC implementation can be costly. Yes, it is costly, time consuming. You have to take a lot of effort for this. Now, it may require significant changes in information system. Yes, it is also correct. It is suitable for all types of organization without exception. Is it suitable? Is it suitable for traditional type of business? No. It may face resistance from employees. Yes, you are using new technologies in this. So there might be some employees in your company who may resist for these type of changes. This is also true. 1, 2, 4 are correct. Option C. A US multinational considering a project in Brazil. The project's cash flows are forecast in Brazilian real, their currency. Now, what is the recommended approach to assess the project's value for US shareholders? Here we are talking about US and Brazil. So what you have to do in this case that you have to convert, yes, it is 36B, correct. Convert real cash flows to US dollars using their expected exchange rate, then discount, then you have to do the discounting. You have to know the fact discounting rate, what is prevailing at that country at the US cost of capital. Now, you have to find which statements are correct. Payback period method considers all cash flows of a project. Do it considers all type of cash flows. Payback period, what it says that the as soon as you are recovering your money, like you have invested 1 lakh rupees, and if you are recovering your 1 lakh rupees in 3 years, in 2 years, in 5 years. Now, which one is suitable for you for payback period? Definitely the second one. In second year, if you are recovering your 1 lakh rupees, that is more better. If you are that the same amount you are recovering in 3 years or 5 years, so it means what is the criteria lower the so better. So till where till you have received your money, you have recovered your money, so that will be counted, not beyond this. So we will not consider all type of cash flows. A payback period method concerns with recovery of cost rather than profitability. Yes, you have to recover your cost. This is the first priority for payback period, and then profitability. This is correct. NPV represents net addition to wealth of shareholders. Yes, this is also correct. Now, ARR considers time value of money. Is it so? ARR and payback period, they does not consider time value of money. That is why we not do discounting in these two methods. Rest all methods we do discounting. And except ARR, rest all other methods they follow which type of cash flow? CFAT. ARR follows which type of cash flow? Profit after tax. B and C are correct. Now, about risk and uncertainty in capital budgeting, you have to find the correct statement. So risk refers to situation where probability distribution of cash flow is known. Yes, when you can assess the cash flows, when you can assess the risk. Uncertainty refers to the situation where probability distribution of cash flows cannot be assigned. Is it so? Uncertainty means what? Where you cannot find the actual value. Okay, where you are not certain for that project. In practice, most investment projects are free from risk and uncertainty. Most of the investment projects they are free from risk. You know, every project contains different type of risk. You have to analyze that risk and then you have to work on it. So this is incorrect. Both risk and uncertainty are important consideration. Yes, this is also correct. So 1, 2, and 4. Option number D. Yes. Now this. Again, 4 statements are given to you. You have to find the correct one. Risk adjusted discount rate, that is RA, is a method where higher risk projects are discounted at higher risk. Yes, for risk adjusted discount rate, the risk premium is given to you. Correct. Certainty equivalent method replaces risky cash flows with their certain equivalent. Now, what is certainty equivalent? It says that if that you are 100% sure for any act for any project, that is certainty. Means you are certain that this will going to happen. Yes, this is also correct. Now, sensitivity analysis examines the impact of change in one variable at a time. Yes, this is also correct. All capital budgeting techniques ignore risk and uncertainty. No. In capital budgeting, we never ignore risk or uncertainty. This is incorrect. All the 3 statements are correct. That is 1, 2, 3. Now, again, previous year question. Which of the following prohibits giving any voting rights to debenture holder? Just now we have studied this. So which section says that? 230, 71 subsection 2, 100 or none? So that is option number B. Now, two statements are given. Yes, it's B of question number 40. Correct. International projects face transfer risk when they involve profit repatriation. Transfer risk refers to the possibility of restriction on transferring the funds from host country to the home country. When profits are being transferred from one country to another country, then it is transferred in a very simple manner, or there are many restrictions. You have to follow each rules, guidelines. It becomes quite difficult for the investor to transfer. Yes, so international projects they face transfer risk when they involve profit repatriation, correct? Because transfer risk refers to the possibility of restriction. That is why there is what transfer risk. So both the statements are correct, and statement one correct is explanation of statement one. Clear? So both are true, and statement two correct explains statement one. So this is what profit repatriation means. What in a very layman language, it refers to sending profits earned by a company in a foreign country back to its home country. That is profit repatriation. Okay, this is the example given to you. Now, what are the modes? What are the profits like dividends, royalties, management fees, and what issues are there when you are transferring profits from one country to another country? That taxes are there. You will get the problem of DTA means in the home country also your tax is in both of the countries, your tax, you have to pay your tax. There is a tax liability in both the countries. So this is for double taxation. Okay. And to avoid this double taxation, there is DTA. DTA is what? It is double taxation avoidance agreement. One agreement has to be signed between the home country and the host country that yes, I'm paying the tax in home country or I'm paying the tax in host country. So they have to sign one agreement. Now, true false question, some true false type of question. NPV, payback period, again NPV. Yes, it is true, correct. 42 true. NPV is the difference between present value of inflows and present value of cash outflows. Yes, true. Payback period method accounts time value of money. No, it does not consider time value of money. It is false. It indicates that the project is expected to add value to the firm if it is profitable. Positive. Yes, it is true. And if there are different NPVs, multiple projects are there, then how you will choose NPV of that project? That is known as mutually exclusive project. And you will choose the one who is having the higher NPV. If you have more than one project, that is known as mutually exclusive project. Now, so this is true, false, true. Now, next, sensitivity analysis helps in understanding impact of changes in one variable at a time. Yes, this is also true. Sensitivity analysis is used to calculate three stages of scenarios. It is sensitivity or it is scenario analysis. It is scenario. That is why it is false. Yes, 49 false. So this we are is having answers. Now, next question number 52, you have to calculate the payback period. Initial investment is given what? First, write the formula of payback, 1 lakh rupees. And you are generating cash inflows what? In first year 30,000, second year 40,000, third year 20,000, and fourth year again 30,000. So how you will find the payback period over the next 4 years? Write the formula of payback period. Initial investment upon capital inflows. Now calculate and tell me if your payback period is not even, if they are all odd. Odd means in 1 year you are receiving 30,000, then 40, 20, 30. So how you will do? You have to find the cumulative frequencies of your payback period. So first year you are getting 30,000, second year 40,000, add 40,000, 70,000, then 90,000, then plus 30, that is 1,20,000. Now, and you have invested 1 lakh rupees. Now, when you will receive that 1 lakh rupees between third and fourth year, you will receive your 1 lakh rupees somewhat between third and fourth year. Tell me. Now, how to calculate between 90,000 and 1,20,000? See, between 90,000 and 1,20,000. Now you have to get how much? 1 lakh rupees. See, so how much is the difference from 90,000 to 1,10,000 is the difference from how much? 30,000. If you will calculate, you will get 0.33. So it is 3 years and 0.33. It means 3.33 years. Now, how to calculate this? If I ask you that, tell me the exact time, exact year, and exact month. Then how you will going to find this? 3 years is permanent. Now, from this 3 years, what is left after 3 years? 0.33 is left. Now, you have to, after year, what comes? The month comes. You have to find the answer in month. 0.33 into 12. What is the answer? 0.33 into 12. That is your 3.96. So, around about 4 months will be there. 3 years and 4 months. So, you will receive your money after 3 years and 4 months. That is your payback period. Clear? Understood this concept? So, this is how you will find the cumulative and then you will get your answer. Now, next question. With reference to sensitivity analysis, see, three statements are given. You have to find the incorrect one. Eliminate the incorrect statement. Sensitivity analysis measures impact of changes in key variables on project NPV or IRR. Yes, if one variable is changed, then you will see the impact on another variables. Which variable are most critical to project? Correct. It's considered simultaneous change in all variables or at one variable at one time. This is incorrect. So 1, 2, 4 are correct. Option B. Yes. Now. Okay, answer is already there. What is happening? Answer is there of profitability index. Now, what is the profitability index? The lower the profitability index, the more desirable project. No. If you are having the higher the profitability index, the more desirable the project is. Option number B. Clear? Now, next question. If the contribution margin is not enough to cover all your fixed expenses, the business will. Contribution margin is what? Your sales minus variable cost. This is your contribution. If this contribution does not cover your all fixed costs, then what will happen? It means if your contribution is, let's take an example, 1 lakh rupees and your fixed cost is 2 lakh rupees. So it is coming in negative, na, the EBIT. Then what will happen? The company will suffer a loss. If it comes in positive, then company will make the profit. Here, contribution margin is not enough to cover your fixed expenses, then you will suffer the loss. Now, cost volume profit analysis question and break-even point. CVP is what? Margin of safety. The difference between actual sales and break-even sales is a margin of safety. MOS. Now, which of the following would cause your break-even point to decrease? How your break-even point will decrease? No profit, no loss will decrease when you will increase your sales. Increasing in selling price per unit. So this is what? This is your margin of safety. Now, this is what? This becomes your break-even point. No profit, no loss situation. When you are making revenue, okay, beyond this. Now, if you are, your cost is over here, and if you are making revenue beyond this, so the gap is what? Your margin of safety. The more gap is there, the more profit is there. The more margin of safety is there, the more profit is there. Okay, and within this break-even point, if you are making, if you have used your labor resources over here, it means you have used them, you have underutilized your labors and your resources, your machines. That is why you have made the loss. Clear? Understood? Margin of safety is what? It is the extra sales a business will make above the break-even point. It shows how much sales can drop before business starts making a loss. This is all about margin of safety divided by actual sales into 100 in percentage, and margin of safety formula, actual sales minus your break-even sales. So you can find with two, the simple unit-wise formula is given and the percentage-wise. Now you have to calculate net present value. Project cost 50,000 and generate cash inflows of 20,000. First year, second year 15, third year 25, fourth year 10,000. Now discount rate is given 10%. How to calculate discount rate? I have told you that 1 upon 1.10 is equal to, if you will do 1 divided by 1.10 is equal to, you will get what? 0.909. Now, when you get this answer on calculator, in this answer, just do equal to, if you will do equal to again, you will get the discounting factor of second year. Again, if you will do equal to again, you will get the discounting factor of third year. Again, you will do equal to, you will get discounting rate of fourth year. So this is how you will do the discounting. Now, project cost is 50,000. Inflows are given what? 20,000, 15,000, 25,000 and 10,000. Now, what is present value interest factor? 20,000 into 0.909, the answer 0.909 into 0.826 into 0.751, this is present value, into 0.683. If you will calculate all this, you will be getting this answer. Now, Once you have got this answer, what is the total value? Total value comes 56,175. And you have invested how much rupees? You have invested 50,000. So 56,000 minus 50,000, 6175. The answer is positive. It is greater than zero. It is positive. It means this is good for you. You can accept this process. Clear? Any doubt in NPV? So present value of all your cash inflows minus present value of all your cash outflow. Now you have to find the correct sequence of ABC costing. Okay, just do equal to in calculator. Okay, when you have, like, if it is given 10%, suppose if it is given 20%, 20%, what you have done, you would have, you have to do it 1.20. Okay, if it is given 5%, so 1 upon 1.05. So like this you have to do, then equal to, again equal to second year, again equal to third year, fourth year, 5 year, 6 year, till the question asks you the years. Now question number 59. First, collection of cost pool is there, or identification of main activities is there. First step is identifying the main activity. So this is eliminated, this is eliminated. Now, after identifying, what you will do, you will collect, you will do the cost pooling, collection of cost pooling from different activities, or you will determine the activity cost driver. So first you will collect the cost pool, you will make the cost pool, then you will determine the activity cost driver, that which activity is giving, which cost driver is giving, which active, from which activity it is coming. Then calculate the activity driver rate and charge the activities, cost of activities to different products. Option A. So this is all about your steps. Now, next, this is uneven cash flows are the discount rate 12% is given. Can you calculate this question? Can you solve this question? Again, initial investment 85,000, inflows 40,000, 1 year 35,000, 30,000, 10,000 and 5,000 for 5 years. 1, 2, 3, 4, 5. Now discount rate is given 12%, 1 upon 1.12. Do equal to, what is the value coming? Tell me. 1 divided by 1.12. 0.892. Again do equal to for second year. 0.797. Again do equal to for third year. 0.711. Again equal to 0.635. So first, second, third, fourth, again equal to 0.567. Now, this is your present value. Now, if you will multiply with each of them, you will be getting this answer. See, 0.892, 0.797, 0.712, then 63654. Now, if you will calculate, if you will sum up all these values, you will are getting 94,170. And how much you have invested? 85,000. Again, it is in positive. You will accept this first. Next question. You have to find the correct statements. Cumulative preference shares entitle shareholders to receive unpaid dividend in future if it is not paid in a given year. Correct. Non-cumulative means do not accumulate the unpaid dividends. Yes. Participating means you can participate in extra dividend also. You can participate in the liquidation value also. Non-participating preferences provide additional dividends. You are non-participating means you will not get any kind of additional dividends. Only the dividends which you are mandatory to give the preference shareholders, only that dividend will be provided. No extra bonus dividend, extra liquidation value will be provided. So 1, 2, 3 are correct. Okay, both the do this 1, 2, 4. Now next question. Convertible and non-convertible preference shares. Convertible means those preference shares which can be converted into equity shares later on. Till the time, if you want to enjoy the benefit of interest, you will enjoy the interest benefit. After that, if you wish, you can become the equity shareholders. You can convert into the ordinary shares. Yes, one more name is there, ordinary shares, the common stock, the common equity, the ordinary shares, the owner's equity, and the equity share capital. All these are the one way. Convertible preferences offer potential for capital appreciation. Yes, when it is converted, you will become the equity shareholders, and again the capital appreciation will be given. Why? Because equity shareholders are the owners of your company, so they will be given the appreciation, capital appreciation. Now, non-convertible provides only fixed dividend income. They do not get the chance of conversion option. No conversion option is given to them. Why? Because they are non-convertible. Yes, this is also true. So all the statements are correct. 1, 2, 3, and 4. Now, next question. Again, I'm telling you, those who have joined this session new, kindly subscribe the channel. And if you think that sessions are helpful to you, then you can like the video as well. So we have different types of risk. Liquidity risk. What it tells you, liquidity risk, that inability to sell your assets quickly, to convert into cash quickly. Credit risk, it arises due to the borrower's default. Market risk due to market fluctuation, and operational risk loss due to failed processes. So that is 4, 3, 2, and 1. Now next question. What is break-even point? Company is selling product for rupees 50. Variable cost is how much? Rupees 30. And fixed cost is given 40. 40,000. Break-even point. So break-even point can be calculated in two ways, in value or in units. Now, in value, what is the formula? Fixed cost upon PV ratio. And in units, what is the formula? Fixed cost upon contribution per unit. Now, what is PV ratio? PV ratio is your profit volume ratio. Now, what this ratio tells you? It tells you the relationship between the profit and market share. So that is fixed cost upon selling price minus variable cost. 40,000 is your fixed cost. 50 minus 30, that is 20. That is 2,000 units. Answer B. Now next question. question on expected return, APT, arbitrage pricing theory. We have to calculate the expected return for an international process using APT. APT is arbitrage pricing theory. Now, what is arbitrage? Arbitrage is selling and buying simultaneously. Suppose you have bought, okay, you have bought, like, let's take an example, securities. You know that in coming time, the value of the securities will be going very high. So what you are doing right now, you are purchasing securities like what one security costs rupees 100. So you have purchased 100 securities into 100, so that is 10,000. Now you have purchased the 10,000 securities and you are selling in that market where the value of securities are very high. Like it is double. Okay. So now the value of 10,000 securities is what? Is 20,000. So you are buying from here and you are selling from here. The differences between the prices is what? That is your profit. And that is known as arbitrage. Now, suppose multinational company is evaluating its overseas project and this project has certain macroeconomic factors. A macroeconomy means factors as a whole. Means the whole economy is getting affected. So GDP is given, GDP growth is given, global GDP. So for GDP growth, the risk is what? Beta is 1.1. Beta is what? The risk, systematic risk. Now, risk premium is what? For if the risk is given, then to cover that risk is also given by the company. Now, to cover the beta risk, GDP risk premium is given 3%. Similarly, to cover beta, the foreign exchange rate value risk premium is given 2%. For commodity, risk premium is given 1.5% and beta is 0.4%. And the risk-free rate is what? That is 4%. Now, how you will going to calculate? You have this formula. RF is what? Risk-free rate plus beta into RP1. Beta into RP1 is this one. Beta 2 into RP2, foreign exchange. Beta 3 into RP3, commodity price exchange. Now you have to find the expected return. So you will sum up all the values. B1 into RP1, B2 into RP2, B3 into RP3. So 4% plus 1.5 into 3% given risk premium, 2% minus 0.4 into 1.5. If you will calculate, you will be getting this answer, 8.1%. Yes, correct. Clear? Now, next question again. Suppose you have two international projects, same risk is given. Identical betas are given, GDP, inflation, and currency risk. And for these beta, the risk premium is given to you. So simply what you have to do, 3% is your risk rate plus 1.2 into 2% plus 1.5 into 0.8 plus 0.5 into 2.5%. Now, if you will calculate, you will get this answer. The same type of question, only the numbers were different. Done. Now, next question. Two statements are given, brown field and green field. Foreign direct investment. There are two terms, FDI and FPI. If you want to do if you are investing in any company, in both the cases you are investing. But the intention of investing is to take the control of that company, you will do FDI. Your intention is to just to make profit from that company, you will do FPI. Now, greenfield FDI is what? You are doing investment in entirely new business, new area, new infrastructure. Brown field refers to sustainable. Brown means what? It is old. Or you can say dull. So brownfield means already the business is there. You are setting up your business over there. Okay. So that is what it invests in sustainable and green project. No, brownfield it is what the old type of project. You are investing in the old pattern of business. So statement one is correct and two is incorrect. Now next, social cost benefit analysis. Three statements are given. So primary focus social cost benefit analysis, what it says that in whichever project you are investing, you have to do the concern for your environment as well. Okay, that project should be sustainable. It should create no harm to the society, and you have to take care that no person is getting effect from such kind of project. So the primary focus of SCBA is to maximize net social benefit, considering quantitable and non-quantitable impact. Yes, it can be applied to sectors, healthcare, education, infrastructure. Yes, it does not require any adjustment. Is it so? It does not require any adjustment for income distribution. No, it requires adjustment. You need to take care of your environment also. So that is, it is incorrect. So one and two are correct. Now, next question, 69. Yes, correct. Vinodji and Swatiji. A. You are talking about 68. No, 67. It is option number C is correct. 68 A is correct. Direct portfolio invest involves investors purchasing foreign asset without intermediaries. Direct means you are investing directly in another company's project. No intermediary is there in between you and the foreign country project. Yes. Indirect portfolio investment involves intermediaries like mutual fund, SCSS, National Pension Scheme, depository receipt, ADR, GDR. This is also true. So both the statements are correct. Now, 70. Two statements are given. Statement 1, statement 2. Now, GDR are issued in the US market with while EDR can be listed in multiple international markets. Is the statement correct? This is given opposite. ADR is issued in US market and while GDR is listed in different multiple markets. This is wrong. ADR and GDR they represent ownership. Okay, they are what? They are the depository receipt. For indirect portfolio investment, this is true. Only statement 2 is correct. Yes, it's 70C. Now, again, three statements are given. Social cost evaluates desirability of project by comparing two social costs, social benefit, what are their benefit, their impact, their effect towards the society. It is only relevant for private sector. Is it so? It is relevant for all the sectors, not only private sector. And SCB helps account for market imperfections and externalities that are not reflected in the market prices. Now, social cost benefit analysis, what basically it tells you that you have to study your internal aspect and your external aspect. If you will study your external factors, then only you can do best for your society. So the use of the prices in SCBA helps account for managing market imperfection, those market which are not perfect market, which is having imperfection and externalities that are not reflected in the market prices because their prices are going up and down. Which statements are correct? That is statement 1 and 3. Now, next. Again, 4 statements are given. Net present value method discounts all future cash flows at the project cost of capital, assumes reinvestment at the same rate. Tell me. So net present value, what it says, it is the discounting rate of all your future cash flows to all your future outflows. Now, it assumes that it is reinvested at the same rate. This one is what? This one is true. Now, IRR method assumes that interim cash flows are reinvested at the IRR itself, which may not always be realistic for projects with high IRR. The payback period method considers time value of money. This is wrong. Accounting rate of return uses cash flows rather than accounting profit. No. Accounting ARR, it considers your PAT, not your cash flow after tax. It considers your accounting profit. So these two, statement 4 and statement 2 is wrong. Now, statement 1 and 2, these two are correct. Option number C. Now, IRR says that whatever money, whatever profit you have made from your project, you will going to reinvest in the same project. Okay. But NPV tells you that you can reinvest in the same rate. So both the options are correct, 1 and 2. Answer is also given 1 and 2. See, I have uploaded the PDF. In that PDF, your answers are also provided to you. Clear? Now, this is okay. Now, this question, last question, 73. A company issues convertible debentures, which can be converted into equity shares. Now, each debenture has a face value 1000. Converted into equity shares, conversion price is given what? Rupees 50 per share. So, conversion, see, we know that if we want to convert our debentures into equity, we should know what is the conversion price and we should know what is the conversion ratio. Now, conversion price is given rupees 51. Now, for every one share, you need to pay 50 rupees. Spot rate is what? The rate which is prevailing in the market. The interest rate, the market rate, which any rate that is prevailing in the market is spot rate. Now, company share in the market, that is 60. Spot rate is 60. Now, what is the conversion ratio, conversion value, and should an investor convert if the spot rate remains at rupees 60? Give me the answer of these 3 questions. Now, what is conversion ratio? See, conversion ratio is what? It is calculated by dividing the face value of the debenture or par value by its conversion price. Now, what is the face value of the debenture over here? 1000. and conversion price was 50. So 1000 upon 50. So that is 200. So your conversion, okay, it is 20. Sorry, 1000 upon 50, it is 20. So your conversion ratio is what? That is 20. Now, what is conversion value? Conversion, see, if you know the conversion ratio is what? 1000 upon 50, that is face value upon conversion price. If you know one formula, you can find the value of another formula also. Conversion value is what? The conversion value or conversion price, conversion ratio into MPS, the market price per share. Ratio was 20. This ratio was how much? Conversion ratio 20 and market price per share is what? Share in the market is 60. So that is 60 into 20. It is 100, 1200. Now next question what it says that should an investor convert if the spot rate remains the same? Now if the spot rate is 60, it means it is coming how much? Conversion value 1200 and the value of the share was 1000. So value of the face value was 1000 and conversion value was 1200. So again, it is good deal. Yes. So it is what? It is advantageous for the investor to convert debenture into equity by, because the face value it is what? 1000 and the conversion value they are getting 1200 at the current spot rate. Clear? So converting is what? It is beneficial for the investor. Understood this question? So today also we have completed 73 questions. Yesterday we completed 74 questions. 73 and 74 in module A. So those who have not watched the module A session, so please watch that session as well. So tomorrow we'll start with our module C. In the morning we will be completing module C capsule and we'll doing questions on our YouTube channel at 7 p.m. onwards. Clear? So again, questions will be around about 70 questions will be there in tomorrow's session also. Now, and don't worry, PDF will be uploaded after the session gets over. So let's meet in tomorrow's session. And yes, please subscribe to our YouTube channel, vote the channel, and kindly like the video as well. And if you're having any kind of issue, any problem, then do mention your queries in the comment section box. So I'll reply definitely. Yes, so take good care of yourselves. Let's meet tomorrow in the morning for paid users from 7 a.m. to 9 a.m. and in evening from 7 p.m. to 9 p.m. for our marathon session module C. Yes, thank you very much for, yes. So thanks to all those who were consistent watching my sessions from the starting only. So let's meet tomorrow. Till then, take care everyone. Goodbye. And PDF will be uploaded after 1-2 minutes. Bye bye everyone.